Welcome. This is the ESOP Guy, and we are on a journey to an ESOP. Thank you so much for joining today. And as always, I wanted to just explain this podcast is a resource for those that are thinking that they might want to use an employee stock ownership plan in their business. That could be strategically for the succession and exit plan. That could be really working through growth strategies, a lot of different ways you can use an ESOP. And this whole focus of this podcast is to help people to understand the process of going through ESOPs. And so a lot of times we'll take topics and we'll just break it down and really explain some things that I think are very helpful. So if you have an interest in the podcast, please go to our website at journeytoanesop.com and you can find all of the episodes for the podcast. So periodically we do get some opportunities to interview some folks. And today I'm excited to interview Jeff Gelburd with Murray Insurance. We're going to talk today about fiduciary insurance. And one of the things about this topic, I will say that it's not the first thing that people talk about. When we talk about ESOPs and the company's thinking, hey, I want to go through an ESOP process, it's not the first thing that we get to talk about, but it's a very important topic. And I wanted to do it justice and really give it some space here. To just explain what is fiduciary insurance, how does it work? Some of this is really the long-term ongoing costs that an ongoing ESOP company is going to bear through the insurance costs. Part of it is the trends that we see in the ESOP community as insurance goes up for ESOP transaction trustees. That certainly is going to impact the cost of ESOP. So I think it's a very important topic, and I appreciate Jeff coming on the podcast today. Jeff, thank you so much for joining.
Thank you, Philip. Appreciate being here.
Great. So real quick, Jeff. So geography wise, where are you housed out of mostly? I know you have clients all over the country, but where do you?
Yeah, in South Central Pennsylvania, really Mechanicsburg, which is it's across the river from the capital of Pennsylvania, Harrisburg.
Okay, great. And so it's still pretty cold up there?
Especially this morning, it was in the low 20s.
Oh, wow. Yeah, that is cold.
Yeah.
Well, great. Well, we're all inside anyway. So why don't we start with this, Jeff? Can you give us kind of a little bit of your background in terms of, I know you do insurance work, but also relative to ESOPs and the ESOP industry?
Sure. Yeah. So I first got involved with ESOPs back in the early 1980s. I was working actually for one of the largest dental manufacturers in the world that's located in York, Pennsylvania. They were publicly held on the New York Stock Exchange, and in the early 80s, they were a target for a takeover. So they took themselves private and initiated the ESOP in the early 80s, and I had just become aware or known of ESOPs from a conference I had attended. But so I was involved initially with this initial transaction, and this company had operations across the globe, and they eventually set up ESOPs in various countries where from a tax standpoint you could set up an ESOP, and they were pretty much like Switzerland, Australia, Canada,
Wow.
the UK back at that time. The Inland Revenue Service, you couldn't invest more than 10% of the planned assets in employer stock. So that didn't come about until after I'd left. But so part of my responsibilities in the finance department was to administer the ESOP and get the plan statements out and so on and so forth. So that was my first entree into ESOPs. And then the company I was with, they had difficulty getting D&O and fiduciary insurance because there was litigation. The public shareholders had sued the company, and so once the ESOP was announced, once they took themselves private, they felt the stock value wasn't high enough to pay them off when they did go private. So that got me into part of my responsibility at this company was the insurance aspect, the risk management insurance. And so I had a hard time getting insurance for the company at subsequent renewals. But I left then. I left that company and I went to the insurance brokerage side. Again, staying local in South Central Pennsylvania. I went to work for a national insurance broker. And they had a lot of affinity group programs. So I went to the ESOP Association in Washington, D.C. I had already formed a relationship with the association while I was at this manufacturing company, because we were members. We got a lot of information from the association and about communications and that type of thing. So I went to the ESOP Association and said, would you be interested in a fiduciary liability program for your membership? And they said, sure, if you could put something together. So I went up to AIG, the headquarters there in New York, and talked to the pension fiduciary people at AIG, presented everything about ESOPs to them that they would want to know from an underwriting standpoint. And they were willing to underwrite a program where they would individually underwrite each ESOP account that I bring to them as the insurance broker. So the ESOP Association, this is like more like 1989. The association then endorsed the program, and it started out as a fiduciary only type of offering. But then after about 5 years, we merged it with D&O insurance, directors and officers liability insurance. And about the same time, employment practices liability was another line of insurance that was coming about in the mid 1990s. And that insurance is to cover claims against the ESOP company or against any company alleging wrongful termination and discrimination, that type of thing. So we were merging all three of these coverages into one package policy. Now, the only thing with AIG was that about the same time, they wanted to put on a ESOP fluctuation exclusion, which basically would exclude any claim that was brought because of the stock value fluctuating. And I couldn't live with that. So we went out to some insurance companies to see if we could do the same thing with someone else. And lo and behold, we were able to convince Great American Insurance Company to underwrite the program. And they were the perfect fit, in my opinion. They liked ESOPs. They gave us an exclusive so that any insurance broker that went to Great American with a submission from a member of the ESOP Association would have to come through me to get a quote. So that protected me, and Great American did a marvelous job in terms of a competitive price and broad coverage. And so that went on for several years. And, I would always invite Great American, the underwriters, to these ESOP Association meetings, just so they could learn more about ESOPs and be more intelligent about underwriting ESOPs. That underwriting group they're headquartered out of Schaumburg, Illinois. So they were members. They went to Illinois chapter meetings and Midwest chapter regional meetings as well. So it became a good relationship, and they're still involved today. We still have the exclusive with the ESOP Association, and so the program is now, we've got at least 350 companies across the country that we insure. We have branched out a little bit to other insurance companies as well, because some of these ESOP companies, they want to buy higher limits of liability. So we'll go to another insurance company in that instance to tack on another $3 or $5 million on what they already buy with Great American. And the big selling part about this program, really, Philip, is the fact that I work with the local insurance agent or wholesaler. Okay. So someone out in California, for example, who doesn't know who Murray Insurance is, they can have their broker or agent contact me, and I can include them in the transaction. So the majority of the transactions that we're covering today will include the local agent or broker. And insurance, like anything else in business, is local. So having that local connection really helped grow the program.
Yeah. I mean, people definitely want to keep dealing with the same people they dealt with in their relationships they had. So you're kind of, are you like the godfather of ESOP insurance? Because it sounds like you were like the forerunner of going to AIG first, and then kind of paving the way with the Great American, with the ESOP Association. And that's pretty pioneering, right?
Well, I got the idea back when I was with this manufacturing company, this dental manufacturer, and that, they were having a hard time getting insurance, and the VP of finance, who I reported to at the time, said, why don't you go to the ESOP Association and see if they have a program for fiduciary and D&O. And I did at the time, and they did not. So that I kept that thought in my head a couple years later when I did go over to the insurance broker role.
Yep. Well, so let's kind of bring it to the basic elements, because I know a lot of people that listen to the podcast, they're not ESOPs, so they're kind of wondering, like, what is this whole thing about? When we think about insurance, we just think the basics that, hey, we're protecting against some potential risk. What are the risks that we're protecting the ESOP company from, or the like what we'd say the fiduciary folks from? And what should they be concerned about?
So the biggest risk for an ESOP company is really the fiduciary side. It's the Department of Labor, who in the last maybe half a dozen years, at least, has taken a very aggressive approach to investigating, subpoenaing ESOP companies, especially in the first 3 years after they've been formed. And their main concern, the DOL is mainly concerned with how the valuation firm was selected to value the stock at the time of transaction. They felt that the DOL, and perhaps rightfully so, felt that if the owner of the business that was selling the business to the ESOP selected the valuation firm, that he or she was going to select someone that they felt would develop a higher stock value, which would be beneficial for the selling owner.
Yeah.
So
lack of independence on the valuation side.
Yeah, and so what the DOL became more comfortable with is where when the transaction is being done, that the company that was considering to go ESOP would hire an outside trustee, who would then in turn hire the valuation firm. So they're more comfortable with that situation. But like I said, the DOL is still pretty active in their litigation, and that's the biggest risk to an ESOP. I would say the second maybe biggest risk is the plan participant themselves bringing a claim, and that would happen maybe in a stock drop case, where they felt that the ESOP was informed improperly, and the value was way too high for the ESOP to buy, and then in subsequent years, the valuation dropped, and that happens sometimes because of the amount of I guess liability and the kind of banking that they do to set up the ESOP, the transaction itself, kind of submerges the ESOP company in terms of debt. And I think that's the initial debt that the stock maybe valuation would drop in subsequent years. That kind of tips off the DOL, tips off the plan participants. And as you can imagine, there's plaintiff attorneys that go after this type of thing.
Sure. Yeah. It's an active area that they get to practice in. I think that for a couple things on the risk side, I know that, and I've seen this in transactions that I haven't done, but I've seen it where there's a lot of motivation in some transactions to just get the highest value. The DOL, like you mentioned, the Department of Labor issued that process agreement. I think it was in 2014. But I don't believe it's still, I still think you have the risk of an investment banking firm trying to make a lot of money on a deal that convinces their client to submit basically a projection that is unrealistic. And that projection is going to equate to a discounted cash flow value that gets negotiated between the trustee and the valuation firm. But at the end of the day, if they buy off on it, it could put a severe amount of debt on the company. So I think it's part of this is to say, I think part of it is how you, as an ESOP or a company that's going to set up an ESOP, how you select your advisors and make sure that as you're working through the beginning steps, you're doing it the right way. But the other side of it is to also understand that this kind of risk exists. So if we bring it back to your, no matter what happens, you're still going to have this sense of risk to it.
Yeah. It's interesting. I still get some insurance submissions today that do not involve an outside trustee. And that really throws up a red flag.
Yeah, that seems crazy to me, considering all the court cases. So do you have any all the plans that you guys have done insurance wise, what would you say percentage wise, statistically, you guys see are claims that against that type of insurance?
The claims that we see are not as frequent. We may see one or two fiduciary liability type claims, but when you get them, they're going to be expensive. So, and the thing to keep in mind about this insurance policy is that the limits of liability that you purchase, defense costs, the cost to defend yourself in these claims will erode the limit of liability. So unlike automobile liability or general liability insurance, where defense costs are paid outside of that limit of liability, with this type of insurance, the defense costs are inside the limits and therefore erode the limits. So they can be very costly. The more frequent type of claims, believe it or not, aren't necessarily because they're an ESOP, but because they have employees, and that's the employment practices liability risk. Okay. So that's the kind of claim that any company, ESOP or not, can get involved in, where an employee feels that they were wrongfully discharged or discriminated against. And so we see more of those kinds of claims. They can be expensive, but generally, if it's involving the average employee with a sort of average salary, they could be maybe couple $100,000, including defense costs that are paid. But we see more of them as being frequent. The other aspect that we haven't talked about is directors and officers liability insurance. So the D&O insurance dovetails very nicely with the fiduciary liability, because I have seen claims where they've sued the fiduciary and then they've also brought in the directors and officers. So the directors and officers of a corporation who may not be acting as an internal fiduciary or internal trustee could be brought in, and that would be covered under the D&O portion of the policy.
Yeah. And so you're seeing the majority of plans for insurance programs include the three merged together, like you guys have bundled those together. And that's
right.
Yeah.
Right.
Do you, and the limits on that are generally, what are you seeing like is RFP coverage limits?
So generally it depends on the size of the transaction, and the limits of liability that are available start at about $1 million, and you can buy those limits shared or separate. So if you buy those three coverages, that $1 million can be separate. $1 million for D&O, $1 million for fiduciary, $1 million for EPL, or they can be shared by the three coverages. It's less expensive if they share that limit. But newer transactions, we're seeing at least $3 to $5 million of limit being requested. We do a article about once every 3 or 4 years, because we get asked this question a lot. We did an article on the limits of liability that ESOP companies are buying today. And we just basically look at the data that we have in our own program, and 300 or so ESOP companies is enough data to come up with an opinion. And we do the comparison based on plan asset size, corporate asset size, if it's different, and number of employees. And that kind of gives ESOP companies an idea as to what limits may be appropriate for them. So a $5 million transaction, they may only need a $1 million limit. But if it's a much greater transaction than that, maybe 20, 25 million, even a $100 million transaction, they're looking at least 5 million or so. Yeah. But it's also based on really what they can afford, and the overall cost is a big factor as to what limits they do in fact purchase.
Yeah, I mean, some of this, it comes back to, again, planning, because when we do a forecast, we have to plan the ESOP compliance costs. So we have to kind of think forward a little bit and say, well, based on the transaction size, we think that you're going to need $1 million policy. And right now that costs X, and then build that in. So I think that, because cash flow especially for the next couple of years is key, because you've got all this acquisition debt. And so the bank wants to get their money back. The sellers want to get moving on their payments. And so,
well, that's kind of like, that's frequently what I hear on these new transactions, is that they didn't have a really good, strong idea as to the amount of fees that are involved in doing a transaction. But $1 million policy for this coverage generally starts at less than $10,000.
Yeah.
So it kind of gives you an idea as to what the costs are.
Yeah, that's kind of my experience. Most of it we negotiate with the trustee, so the trustee kind of says, hey, this is what I want you to have. And so part of that is to get a sense for early on, again, what you think that's gonna look like. But I appreciate like you breaking it down into sizes, because I certainly $100 million deal versus a $5 million deal are not the same risk profiles at all.
Well, we just got a submission in a week ago with a $250 million risk transaction, and yet they were having a hard time getting insurance because of some prior litigation. But they're just happy if they can get $1 million at this point. But it's something to build on.
Yeah. That's another part, right? Yeah. So if you have other lawsuits or whatever going on, it's not like you're going to be able to insure everybody.
Yeah. You're not a very good risk to, as seen by other insurance underwriters. Right.
Yeah. And I think that's a point I want to make. Like, I'm kind of making the point of planning it early is better than later. So you probably, like I had mentioned in the very beginning, nobody's really thinking about insurance at the very beginning of talking about ESOPs. We think about taxes, we think about cash flow, what the warrants might look like. But it may make sense for your company if they have had some issues prior to this with employee lawsuits or whatever, to get a quote prior to it, or just get to an idea if you can even get insurance placed. Because if it's a requirement of the ESOP deal, then you're kind of in a rock and a hard place.
We oftentimes get the submissions or the interest to buy insurance right at the last minute. It is the last minute thought of getting insurance.
It is,
and it's much better if you can go earlier. The insurance company may want to put on an ESOP exclusion until the ESOP is then formed, and then they'll take off the exclusion once they've seen the valuation.
Okay, yeah, and then everything gets official at that point.
Yeah. Right.
Yeah. Is there a problem where you have a brand new ESOP that we agree to get insurance, but we don't really get the insurance placed for 6 months? And now we have this 6 month, we have an ESOP that's 6 months old, has zero insurance, and then you're like, I'll put it on afterwards or whatever. Is there an issue with that, or is that?
Well, no, not really. I mean, the issue more lies with the ESOP company and the outside trustee, that typically the outside trustee will have it on their checklist to get the insurance. But we have seen where it's been 6 months, a year post transaction that they're getting the insurance for the first time, and that's fine. That's fine. But what is key to the insurance company underwriters is going to be the applications. Of course, we developed our own ESOP questionnaire, and this is something that going back to the AIG days, they were very. I think only one insurance company back then, the Aetna, was doing a specific ESOP questionnaire, a one-page thing. And so I took that to AIG, and they were happy to see that, and it made them feel better about ESOPs. And we're still using it today. And the questionnaire basically goes through, the how, why, and when of the transaction, and do they have an outside trustee? Who is that? Who's doing the valuation? Who's doing the plan administration? So it gives a lot more information to the underwriter than the normal standard D&O fiduciary application. And the valuation is going to be key. And so what happens is that, we can't get the valuation of the initial transaction until after the transaction. And they want the coverage bound at the date of transaction. So what we've worked out with the insurance company is that we'll hold the effective date being the date of transaction, but it could be a couple weeks later until they get the valuation and the insurance company signs off on it and says it looks good, that we can then get a binder but at least the transaction date is still, the initial, the effective date is the initial transaction date. So it's just that they have to be a little patient to get, wait a couple of weeks before they can get the coverage bound.
Well, and I think when you get the valuation, you have to get it from the trustee with an NDA,
Right.
because nobody
Yes.
can get that valuation except for you guys and maybe
Yeah.
the bank, but it has to have an NDA attached.
No,
to it.
and me as a broker, I don't need to see it.
Yep.
So I just have the insurance company sign the NDA and send that back to the outside trustee. I don't need to see the valuation.
No, for sure. On the beneficiary side, so let's just say you had a claim. What I'm used to understanding is that it benefits the trustee primarily.
Right.
If there's an issue with now we've got a bundle, we've got a D&O, we've got the employee practice limit liability insurance plus the
Right.
Fiduciary. How does that work with, say it was $1 million policy and obviously the trustee is going to benefit first, but then you have other people being sued.
Yeah. So the fiduciary coverage, the fiduciary portion of the policy will cover the ESOP itself, the plan sponsor, and the individual internal trustees or fiduciaries. Basically, it covers the ERISA definition of who a fiduciary is. So that's, so the insurance policy doesn't have its own definition as to who a fiduciary is per se, but it'll also cover the employee. And they have this, what we call it says on the policy, definition of an insured person will include a natural person. And that natural person really can include the outside trustee. So if you have an individual serving as an outside trustee, he or she would be covered under this policy. This policy, however, would not cover an institutional trustee. So they still have to rely on their own coverage. The institutional trustee does. But so
why doesn't it cover an institutional trustee?
It's the feeling by the insurance companies that they don't want to cover an institutional trustee because they're more prone maybe to litigation, and B, the insurance company feels they may be liable to pick up other transactions the institutional trustee may be working on, which I don't agree with. But at this point in juncture, right now, we're kind of happy just to get the outside trustee covered. If that's the desire of the ESOP company, the ESOP company is the named insured. It's really up to them if they want to have the policy extended to the outside trustee.
Right.
In most cases they do. Yeah. But they got to realize that they're sharing their policy limits with an outside trustee. Yeah. And they in turn should be looking at the outside trustee to see what kind of insurance they have as well.
Yeah, for sure. Well, with an individual trustee, they already have insurance too. So this other part is just part of like each transaction or each client they have. How do they go? Like they would, if they get through that first level of insurance with the company's insurance, then they need to go to theirs second after that. Is that how it works?
Yeah. So if both the outside trustee and the ESOP company are named in litigation, there is what they call the other insurance clause in an insurance policy. So each policy would have that. The trustee's policy would have that other insurance clause, and so would the plan sponsor. And basically what happens is they do a pro rata based on the limits that are covered. And so it could be 50-50, it could be 30-70, something like that. Yep. As far as what's paid.
Yep. That's good. Yeah. Because otherwise, well, I'm just assuming this works however all insurance works. So if they get a claim, their insurance is going to go up premium wise, right? After that. Right.
Yeah, more than likely. But I will say Great American's been pretty fair with the increase after a claim's been filed.
Okay.
They don't try and get back all the money at one time. So, if you're willing to work with the insurance company, it's not going to be that difficult. It's going to be hard to move insurance after they've had the claim too. Not a lot of insurance companies will want to underwrite the account if there's been other litigation involved.
Yeah, jumping into potentially a bad situation. It could have been just completely innocent, but you never know, I guess, with that kind of stuff. So the trends, what are the trends are like? I know that costs have been going up for trustees insurance.
Yeah.
And we can intuit that
Right.
there's a lot of high, maybe heavy claims going on in the industry. What are you seeing on the trend side?
So for the plan sponsor buying, the ESOP company buying coverage, uh, back before COVID, the rates were going up, 5% maybe at a clip. When COVID hit, insurance companies decided not to underwrite, not to cover certain industries like the hotel industry, the restaurant industry, any industry associated with travel. They were not going to underwrite.
Mhm.
The underwriting became more involved. There was a separate COVID questionnaire. So rates were going to be going up 10 to 15%, plus a lot more underwriting going on.
Mm.
Um, Now that we're kind of through the COVID situation, rates are coming back down. So we're seeing anywhere from 0 to 5% in the way of increases. There's more availability today. We're seeing more insurance companies underwriting ESOPs, which is a plus. It's become more of a buyer's market than it ever has been, and for buying the insurance. But not to say, you could still have difficulty getting insurance if the financials aren't as strong, if there's been some prior litigation. You could still run into some difficulty. The outside trustees, that's a whole other situation where they're having a lot more difficulty getting insurance, the outside trustee. And
Mhm.
there's been some movement with looking at alternatives for outside trustees, such as captives or a risk retention group. And it's all a matter as to whether or not this mass of outside trustees is large enough to do a captive or a risk retention group. But they're still going through some difficulties getting coverage.
Yeah. Do you have any idea? This is a hard question. How many trustees there are in the United States? Like something I always wonder.
Yeah, without not including the institutional trustee, I would say it's a fair bet that there's less than 100
Yeah.
outside trustees.
I mean, that's a huge, if people actually stop and think about that, and this is why
Yeah,
when I do ESOP transactions, I do, obviously I'm working with a lot of the same people,
right, right.
transaction. I do an interview process, so we're not picking the same one every time, but at less than
Yeah,
100, and I think that the issue would be that I just see, I think it's obvious is the costs go up, and there's a couple things I think that happen with trustees. It's like they get their plate full. At some point, how many companies can you handle, if you're going to be the ongoing
yeah,
trustee? And so you get some of them that are individuals that are not building like a deep bench, with
yeah,
another person or whatever, a trustee, then they're going to max out. So you're going to have those guys be done with transactions at some point. And then the other side of it is continually the cost increases for insurance make it, more
yeah,
difficult for them too. So,
yeah,
that's
yeah.
a problem for our industry if we don't have enough
Well,
trustees.
it is. It's a catch-22, right? The
Yep.
DOL wants the outside trustee involved, but on the other hand, they're making it difficult for them to getting insurance by what they're doing on the litigation side.
Yeah. So right now the trends for the outside trustees, you're still seeing increases on their insurance.
Yeah, and difficulty getting good terms. There
Mm.
may be exclusion, or sometimes they're putting a sublimit of maybe only $100,000 of coverage for litigation involving a government agency,
Mm.
i.e., the DOL. So it's become more difficult, and it's problems for sure.
Yeah, for sure. So the reason why, COVID made sense for the companies, but for the outside
Yeah,
trustees, what is just because there's larger lawsuits? Is that why
because they're being brought into lawsuits. Yeah,
okay?
they see that the DOL is bringing them in, um, and so these insurance company underwriters, they have an idea what's going on out there
Mm-hmm.
with the ESOPs and the DOL. So it's publicized. They're reading about it, and so that's kind of the issue.
Yeah.
It wasn't like that 15, 20 years ago. We would cover the outside trustee as sort of a professional courtesy to the trustee, and we were using Great American, but all of a sudden the storm happened, and there was
Mm.
all this litigation, and Great
Right.
American said, you know what, we need to back off the outside trustee. So then we went to the what we call the excess and surplus lines marketplace. So these are insurance companies that they don't have to file their rates or their form with the individual state insurance departments, so they're more apt to see a difficult or write a difficult risk than a standard admitted insurance company.
Yep. Well, that's pretty interesting. So I mean, and so as we go through the next phase of things, obviously it's something to continue to watch. Hopefully the trustees, manage it. I kind of always, as I look at the issues, the main thing that we talked about at the very beginning was, why are they getting sued? Well, it's because the valuations are too high, right? For the most part, you could have a plan. You could have a participant that was, frustrated about something that wasn't real. So that can happen as well.
Yeah. But no, it's, we've seen claims that trigger both the D&O and the fiduciary part of the policy. I had one that triggered the EPL, all the same litigation. So, it was, you don't normally see that happen, but it can happen. No. And it happened because the CEO was let go, and he filed an EPL type claim. So we had all three coverages triggered with that one claim. Wow.
You ever see them go after the other advisors at all? Like like I said, the sell side advisor or the ESOP attorney or anybody else?
No. Because I guess from a fiduciary standpoint, they're focusing on the breach of ERISA fiduciary liability, breach of ERISA. So they're not focused on the other professionals that get involved with the transaction. Even the business valuation folks, there was a time that the ERISA was looking at naming them as planned fiduciaries, but that has gone away, fortunately. But I don't even see the valuation folks brought in a lot of times.
Yeah, it makes you wonder, because there's a lot going on in this whole transaction. Right. I would imagine that the trustees coming in, one thing that people ask me, and I'm sure they ask you this question is, because if they form the ESOP, should they be the trustee, or should they build a trustee committee? And it's surprising how many companies I do meet that they have internal trustees. But this is clearly one of the issues. So I don't know if you've seen that in a lot of your clients, that they're just taking on that role.
Yeah, I mean, generally it's going to be the CFO, maybe HR person. The more I guess you have some of these ESOP companies that they get it, and so they want to involve the employees in the various roles. They form an ESOP committee. I have one ESOP company that they have a committee of 7 people. These are people that off of the production line that serve as ESOP trustees. Now, when it comes to reading the financial statements or reading the valuation and making sense of the valuation, there is the CFO on the committee or someone with a financial background, but I see that as a positive thing where they bring in the employees to understand the ESOP. They're 100% and they get it. They act like an employee-owned company should.
Yeah. Do you see that normally when they're out of debt, or is it you see that also during the debt phase?
Not really sure. I don't know if the ESOP debt has much to say as far as whether they would or would not bring in these other employees as trustees, but there are still a lot of ESOP companies out there that they've done a transaction. They're not going to do another one, and they don't have an outside trustee any longer. The company I work for today, Murray, we were an ESOP company, an ESOP insurance agency, and I was asked by our senior leadership, should we have an outside trustee? And I said, unless we're going to go through a transaction to become 100%, I would say you probably don't need to have an outside trustee. But that's the situation was different for us because of my background, and And just we were about 55% employee owned before we sold out to a larger company.
Right. Yeah. I think that's a case by case thing too. And that's why I hate to say, well, never do it or don't do it, because people want to just compartmentalize and make it into a well, you should never do that at all. And
yeah,
I'm making that point just because I think it's very relevant to insurance and fiduciary risk and the idea behind all of that.
No, I think it's really the selling owner that's going to be behind it as far as doing the ESOP transaction. If they really feel that they want to leave a legacy and have the employees and management that's there taking ownership, if they feel strongly about that, they're going to do it regardless of the cost.
Yeah, for sure. Well, that's great. Well, I know we covered a lot of ground. We're pretty much almost out of time. Anything last minute you wanted to kind of mention just for people to be thinking about when it comes to insurance and what we've covered so far?
No, no, Philip. I guess the other two policies or coverages that should be considered and nowadays is cyber insurance. It's very key to have cyber coverage.
Yeah,
that's another type of insurance today that's going through a very difficult time, and so a lot of insurance companies that they offer cyber insurance, they want to see they want to have a ransom questionnaire filled out. They want to make sure that the company's doing MFAs and doing everything properly. They're underwriting the cyber risk more so today than they were 10 years ago when this coverage became available. So that's something that they need to consider. Crime coverage, crime insurance is important. But I think with the D&O and the fiduciary coverage, it is a different looking insurance coverage. It's claims made. It's not occurrence. Defense costs are within the limits of liability. And if there's a change of ownership, then you'll want to purchase what they call runoff or discovery to cover the outgoing fiduciaries and board of directors of the company that's been sold.
Yeah, no, that's great. That's very helpful. I was thinking about that too, because that's come up a lot, the cyber coverage, and I'm not sure what is crime insurance. Just real quick, I'm not sure what.
So it's really employee dishonesty coverage.
Okay.
And so you can broaden that employee dishonesty coverage to include things like forgery and
fraud,
transfer fraud. Yeah. The other thing that they have is social media coverage. So it's where someone inadvertently transfers money to what they think is a legitimate bank. And that kind of coverage is on the crime policy.
Okay.
You see it sometimes in the cyber, but more so on the crime coverage.
Talk about hard to underwrite. I don't even know where you start, the history, I guess, but, I think insurance is such a huge topic, honestly. There's so many things to get into, but, I think we did a good job of covering, the main stuff for ESOP.
No, you asked good questions, Philip.
No,
very good questions.
Yeah, certainly. I appreciate your time today, Jeff, and all that you're doing. And, so if you have any questions, how should people get a hold of you if they wanted to contact you and ask?
So, my email is probably the best. So my email address is jeff.gelburd, Gelburd. I'm sorry that I'm giving my personal email address.
Don't do that.
My business email address is jgelburd. So it's JGELBURD at Murray, MURRAYINS, the first three letters of insurance.com.
Cool.
Now, or telephone would be 717-620-2476.
Cool.
But I appreciate the opportunity, Philip.
Yeah.
Thank you.
I do too. That was great. I think you're just a great wealth of information. So appreciate it.
Thank you.
So with all that, I wanted to say thanks so much for joining today, and we'll see you guys on this next step on this journey to an ESOP.